Gampy, is this a huge potential trap?
Yes.
Yes, it is. That's one of the reasons why we're bringing it up. Okay, who knows anything about 108, Section 108? Noodles? Anything? Brad? Brett? Adam? Okay. For a gift card, let's see if anybody gets it. What is the code section that defines gross income?
651.
651. No.
61.
61. You're a digit off. Okay. 61 defines gross income, right? We can all agree on that. And if we go to okay, so Sam, what's A say?
Except as otherwise provided in the subtitle, gross income means all income from whatever source derived, including but not limited to the following items.
Okay, we're going to stop there. 61 says everything's income until it's not. You have to find an exception. If you have any increase to wealth, it's income. Sam, if I give you $10,000 or 250, whichever the case may be, fine, let's talk about this. If I give you $250, is that income?
Yep.
Yep. But if it was a gift, would it be income?
No.
No, because there's an exception out there that says gifts received are not income. So everything's income until it's not. That's what this says. Okay. So Sam, what does 12 say?
Distributive
Oh,
exchange.
that was 12.
Okay.
Huh. Did they change the rule on me?
So, was it 11?
What the hell? Did they? Oh, it's 11. It's not 12. I was wrong. What's 11 say?
Income from discharge of indebtedness.
Okay. So if I loan you, Sam, $1,000, and then a year later say, forget about it, does that say that's income?
Yeah.
It does. But let's go back to what's A say?
Except as otherwise provided in the subtitle, gross income means all income from whatever source derived, including but not limited to.
Okay. Okay, and 11 says discharge of indebtedness. So this say, and I'm going to go back to my gift example. Well, let's say if I give you a gift of $1,000, is that income to you? Because somewhere in the code section, in the code, it says gifts are not taxable. If John has a building and I have a building and we swap it, Brett, is there an opportunity for us not to have that be an income event?
Yes.
What is it?
1031.
Okay. If I transfer property into a corporation, Stuthman, in exchange for stock, is that income?
No.
It depends. Okay, you have to analyze it whether it's tax deferred or taxable, but that analysis is under what section?
351.
351. Noodles, if I transfer something to a partnership in exchange for partnership interest, do I have income?
99% of the time, no.
What's the code section?
First one we did 722.
721.
721. You're so close.
So close.
Okay. So 61 says everything's income until it's not, and you have to find a specific provision in the code to turn off the income recognition. And what's 11 say, Sam?
Discharge of indebtedness.
Discharge of indebtedness is income. So section 108 says, well, let's just Let's pull that up for the heck of it. And we'll go to my slide. Which I think, Sam, who you want to call in?
Real quick, I haven't seen one of these in a long time. What's the friggin' form number? 1099 what?
For the debt?
Yeah.
I think C. Is that right? That's what popped in my head.
I might be.
That's what populated. Now, my certainty on that's 50-50. You could push me off that pretty easily.
I know, I don't feel great about it.
Does anybody know? I think it's 1099C. John, do you know?
I would have said COD.
Let's see. Let's see if that. I literally would have gave that. That's what populated. That's what my head said, but I was not certain. Okay.
I want to call on Nate.
Okay. So let's go back to what we were saying before, though, Nate. 61 says,
That everything's income until it's not.
11 says.
That cancellation of indebtedness is income.
So now let's go to 108.
Okay.
What's 108 say?
In general, gross income does not include any amount which, but for this subsection, would be includable in gross income by reason of the discharge in whole or in part of indebtedness of the taxpayer. You want me to keep going?
Yep.
If the discharge occurs in a Title 11 case, the discharge occurs when the taxpayer is insolvent. The indebtedness discharged is qualified farm indebtedness. In the case of a taxpayer,
We're just gonna stop there.
okay.
Okay. Okay. Because what I'm most concerned about for purposes of today's discussion is A and B. Anybody know what Title 11 is? Adam?
Bankruptcy.
Bankruptcy. Okay. So does anybody know what insolvent means?
Don't know.
Liabilities exceed assets or something like that.
Okay. That's right. So insolvency is defined as debt minus assets equal insolvency. So to the extent that you're insolvent, you can exclude 108 says that it's not income. So what 108A1A bankruptcy or A1B to the extent that you're insolvent, if you were forgiven a debt and you're bankrupt, 108 says that it goes from taxable income to tax exempt income. It's still income, but you have to diagnose whether it's taxable income or tax deferred income. That's what 108 is doing. It's allowing you to turn off the taxable nature of the 108 income. And in order for that to be turned off, a person has to be either in bankruptcy or has to be insolvent, one of the two. Okay, Noodles, what's Wednesday?
What is cancellation of debt income occur?
It's more like when. When does, maybe?
Yeah. When does cancellation of debt income occur? When a lender forgives some or all of a debt, and then we have Pete borrows $1 million from First National. Pete paid $800,000 and refused to pay the rest. First National forgave / wrote off the $200,000. The $200,000 is income from the cancellation of debt.
Okay. So I have income. Now you have to make a determination of whether it's taxable income or tax deferred income. Because 61A11 says that it's income. And now we have to figure out whether there's something in the code that turns off the taxable nature or makes it tax exempt. And 108A1 and 2 is what does that. So what's 2 say, Noodles?
2 says, is cancellation of debt income taxable to the person who received the debt forgiveness? Section 108 helps assess if the cancellation of debt is taxable income or tax exempt income.
Okay. Who you want to call in? Oh, fuck. I got it wrong. I mean, when I was writing the slide, I put 12 on here. It's 11. My memory's not what it used to be.
We'll go to Kelsey.
Who?
Kelsey?
Kelsey? Okay.
What is the general rule for cancellation of debt income? Section 6111 states that cancellation of debt income is income and is taxable unless an exception can be made. Section 108 is the provision that makes that assessment.
Okay. 4.
What are the common examples that tax exempt or cancellation of debt is tax exempt? If the taxpayer declares bankruptcy and to the extent the taxpayer is insolvent, cancellation of debt is tax exempt.
Okay.
How
Next.
how is insolvency defined? Insolvency equals taxpayer debt minus taxpayer assets.
Feels like we've already been through these slides already. Jeez. Okay. What we got? What's next?
So if they have 150K, well, if their debt is 200 and their assets are 60, they would
50.
be insolvent. 50.
Okay. So First National forgives $200,000 of debt to me. I don't go into bankruptcy. How much of my income is taxable and how much is my income tax exempt? Kelsey,
If you don't go into bankruptcy,
if I don't go into bankruptcy, if I'm using insolvency as my shield,
150 would be tax exempt.
okay,
And what was the total amount?
200.
50 would be taxable.
Okay, does everybody see that? So you have to measure insolvency. To the extent that you're insolvent, the insolvency converts the COD income from taxable to tax exempt. To the extent that you're solvent, your COD is taxable. So a different way of saying that, to the extent you have assets, it's taxable because you could have liquidated those assets to pay off that debt. You could have.
Pete, that insolvency test for partnerships versus S corps, I think, is different.
It is. I don't know that. I mean, you're going to tell me something I don't know.
I thought that for an S corp, you tested it at the corp.
Well, don't go ahead.
My question was if we talked about that, I guess.
We do.
Okay.
We do. That's exactly why we're bringing this up. John's talking about the trap that somebody's going to fall into. Yes?
Well, I don't know if they'll fall in it or not.
Well, possibly. Okay.
Pete, so that bottom graph right there,
Yeah.
should that say 50K taxable?
Oh, it should. I was actually trying to listen to this stupid ass ethics while I was writing this. I mean, the good ethics. That's what I meant to say. Okay. Okay. Kelsey, who you want to call on?
Sam.
Who?
Sam.
Sam, what's this say?
Are there other exceptions in bankruptcy or insolvency? Yes. Seller carryback note, certain real estate notes, others.
Okay. So you on 108 you saw qualified farm indebtedness is an option. You saw, I mean, there's certain real estate indebtedness that you can write off against the building, but anytime you do those, you're going to have to reduce the base of the asset. There are other exceptions, but the one that I've used multiple times over my career is that first one, a seller carryback note. So the seller carryback note, Sam, do you know what a seller carryback note is?
Nope.
Melissa? Kelsey? Adam?
Somebody, you sell your business and sort of operate as the bank,
Sort of operated as the bank.
where you agree to sell your business for $1 million. You're going to take 800,000 up front and the buyer is going to pay you the remaining 200,000 over time. For
That's exactly
example.
right. That's exactly right. So you take a note in exchange for the property that you're selling. That is a seller carryback note. So when you have a seller carryback note, so we're going to use Adam's example of you sold the business was sold for $1 million total, correct?
Mm-hmm.
800,000 was received as cash, and 200,000 was a seller carryback note. You agreed to play bank or take a note receivable from the person that bought the business, correct?
Yep.
And I'm going to pretend it's all goodwill for just 1 second. Okay. How much basis does the buyer have, Brad, in the goodwill, purchase goodwill?
$1 million.
$1 million. The 800,000 that was actually paid plus the promise to pay of 200,000. Well, what happens is you figure out that you overpaid for the business, or economic downturn or something compels you to go back to Adam, the seller, and say, I can't pay the 200. Can't do it. I can pay you 50. And Adam sees the merit of going down to 50 because getting 50 is better than getting 0, because reducing that payment is going to keep you afloat, maybe. So, did you have a note? Was there a note in existence, Adam, of 200?
Was there at the time
Yep.
of sale? Yeah.
And we negotiated it down to what?
50.
50. So was there a reduction in that note of 150, Brad?
Yes.
There was. Does that feel like it's cancellation of debt income?
Yeah.
Because the note was reduced and forgiven. Okay. So since the note was reduced or forgiven, you should have cancellation of debt income. However, when it's between a buyer and seller and there's a subsequent renegotiation of what that note payment is, the IRS says, well, that's just additional negotiation. We're going to not have that be cancellation of debt income. We're going to say that we're going to go back to the date of the original transaction and say the price wasn't $1 million, it was 850,000. Brad, how much basis did buyer have in the assets?
$1 million.
$1 million. So what do you think the basis would be if we have this reduction?
850.
850. So now this is something called a basis redetermination. So now the assets have to be reduced or basis redetermined from the $1 million down to 850. Okay, and whatever, and I've had this happen. I've seen this where there was a basis redetermination where somebody got reimbursed money on a particular transaction of $1 million. Their basis in the asset because of the depreciation taken was 400,000. So they were reimbursed more than the basis that they had. So basis redetermination says as a tax exempt, you're supposed to take the basis down for the amount that you're reimbursed or for the debt forgiveness. So this particular taxpayer had $600,000 of income because there wasn't enough basis to take away, which that was super interesting. That was a Hans special. Okay.
Hey, Pete.
Yeah.
I've run into that before where someone agreed to sell their business $1 million and then they sold it to employees. They're now employee shareholders and they agree to forgive part of that note, part of that original purchase price, and that felt like you have the potential for comp on the buyers. Do you agree with that or no?
On the employees paid $1 million.
I'm gonna give you 10% of my business for $1 million is the original negotiation. And then a year later, they come back and say, you know, you're doing such a great job. And actually they would frame it as there's been an economic downturn. So we're gonna say that 10% of the business was only worth $900,000.
It's going to be fact specific, but if, and I assume it,
You
I
only
assume
need to pay
I assume it's cross purchase.
Yeah. You only need to pay $900,000. So would you look at that $100,000 reduction in purchase price as comp to the buyer? And the buyer still has the full basis of $1 million in their stock, or would you look at it as a redetermination of basis?
Well, I think it's facts and circumstances dependent, but I'm going to use the lens of it's very, very hard to give a gift to an employee. So you're doing a good job. It is a Lutz employee, but you and I have a personal relationship, so I'm going to give you a $10,000 gift, and it's predicated on our personal relationship. But the IRS is going to presume that I'm giving that to you in your capacity as an employee, and they don't care about the personal relationship we have. So, in the case where you have a cross sale and the person's an employee, I think that same presumption that you're motivated by a compensation
Yeah.
or a compensation motive seems like that would be their starting point, and you'd have to have a good reason why you said we renegotiated. The employee says, "Wait, I just can't pay it." I mean, it feels like you could make that argument, but it feels like the starting point for the IRS would be it would be comp, and which would be worse is, it was a cross sale. Who paid the comp?
What do you mean by that? I mean, the company's paying the comp to the employee. What do you mean by
Uh-uh.
that?
So I'm the seller, you're the buyer. I sell you $1 million worth of stock. How much do you owe me?
$1 million.
Okay, and I say forget about it. You only owe me 900. Who forgave the note?
You did.
I did. So it feels like I have an unreimbursed employee expense of $100,000. And on top of that, I mean, this is just terrible. I've seen this all the time, and I get a little cranky with attorneys when they set this up this way. Is basically it's worse because I've given you $100,000 of stock in exchange for services rendered. Kelsey, what's definition of proceeds?
Everything is income until it's not.
Definition of proceeds, not proceeds. Sam, definition of proceeds.
You said the things.
Who?
Debt relief.
Cash, property, and debt relief.
It was like all three grabbed one piece and were like one complete answer.
Teamwork.
It was teamwork. Cash, property, and debt relief. Okay. So in this case, I'm using property to buy a service, and he's being paid a service. So now I'm using property to buy a service. That is going to be income to me. So now my stock should have a gain or loss because I gave it to him. He has $100,000 of income. I have $100,000 of proceeds because I got something called services. Now I have a gain or loss on my stock. That gain or loss on my stock is taxable, but my payment to him of the stock is an unreimbursed employee expense, which is 212 expense, and under the 2017 Trump Tax Act, 212 expenses got turned off or no longer deductible. Does that sound good on any front?
No.
No. So if you actually have this going, I would go with 108 and hope. John, how do you feel about that?
I agree. You told me to put in a accountable expense reimbursement plan and take it as a company expense when I did that or was contemplating that.
Yeah. So what does that mean?
So if I pay for my gas when I drive down here, I can get in theory, could get reimbursed for that because Lutz has a accountable plan, which means if I turn in expenses and prove that I incurred this expense, they'll pay me back for it, and that's all fine. I can receive that reimbursement tax free, and then Lutz deducts it. So also, if I pay for Adam's comp because I sold him shares below fair market value, that is a company expense that I'm being reimbursed for, and I can receive, and I would need to be reimbursed for it. But then I could be reimbursed for selling shares below market value to Adam, and that changes it from my expense to the company's expense, and it's good if it's a company expense.
So in our fictitious fact pattern, I say, forget about it. You don't owe me. But then I look at the company and turn in an expense report to say, company, you owe me $100,000 because I expended something on the company's behalf to further the company's business venture. You owe me for that, and the company gives me $100,000. Then it becomes a company deductible expense. I'm not out the $100,000, and he has comp of $100,000. Okay. Sam, what's 6A?
Is section 108 a complicated provision that we are only touching the surface? Yes, it's more complicated than we're discussing.
Okay, 108, and actually 108 is something that everybody ought to tear into, play with, tear apart, put it back together, because there's all sorts of things embedded in 108 that you could have debt forgiveness and you have to
That means
diagnose what the hell's going on. There's specific rules with S corps. There's specific rules with corporations. There's specific rules for partnerships. There's specific rules. There's just rules. 108 is we could spend, if I felt comfortable enough, we could spend 3 or 4 hours talking about the different nuances of 108. I'm kind of comfortable. I know enough about 108 to identify issues and navigate through it, but I'm not as good at 108 as I am some other stuff. Who you want to call in, Sam?
Brett.
Brett?
7.
Yeah.
Why are we discussing 108? I think it is best to answer this question with the question. Do you think partnerships and S corps have the same treatment under 108?
Do you think they have the same treatment under 108?
Nope.
They don't. Okay. So right now, we've set a baseline rule, have we not? And that baseline rule is if there is debt forgiveness, it's income under what provision, Sam? 6111.
61. Yeah.
6111. Okay. And if there's income under 6111, now we're looking for something to shut off the taxable nature of that, are we not? And where do we find that? 108. In 108, we had two rules that we were focusing on. What were those two exceptions, Leslie?
It was insolvency and bankruptcy.
Insolvency and bankruptcy. So now you're using those two things to diagnose whether we have a taxable event or whether we have a tax exempt event. Okay. So the rule, going back again, debt was forgiven. I took out a loan. Pete took out a loan of $1 million. 200,000 was forgiven. That was our fact pattern, was it not, Kelsey? It was. 200,000 was forgiven. Then we did a little bit of analysis to diagnose whether we have what was taxable and what was tax exempt. So I didn't go bankrupt. I decided not to go through bankruptcy. I measured my insolvency, and my insolvency was debt forgiven was 200. Now I got to figure out my insolvency. Debt minus assets. Debt was 200,000. Assets was 50. I'm insolvent to the extent of 150. Therefore, of the 200,000 that was COD income, I was able to diagnose that 150 was tax exempt and 50 was taxable. Are we all on the same page? But now I want to focus in on where did that analysis lie in diagnosing whether we had a taxable event or a tax exempt event? Whose facts were you measuring? Mine. Okay. So do we think that Pete, an individual, could have debt forgiveness? Brett? Do we think partnership Pete's involved with could have debt forgiveness? Did the S corp Pete's involved with could have debt forgiveness? C corp? Sure. Okay. So any one of those could have debt forgiveness. And now I'm asking here, is there a difference between a partnership and an S corp? And there is. Is that my last page? What the hell's going on? Okay. Brett, what's this say?
Is the COD income for XY S corp tax exempt? Is COD income for AB LLC tax exempt?
Okay, so what this is saying is you have a bank that loaned $1 million to AB LLC, taxes of partnership, and $1 million that was loaned to XY S Corp of $1 million. The bank forgives $1 million of loan to AB. The bank forgives $1 million loan to XY. AB files for bankruptcy. XY files for bankruptcy. So, Brett, is the fact pattern for AB LLC and for XY S Corp exactly the same?
Feels like it.
It is. They're exactly the same. Both borrowed $1 million. Both were unable to pay the $1 million, and both have filed for bankruptcy. It's exactly the same. Correct? All right. Consequences to XY Corporation. Due to the $1 million debt forgiveness and bankruptcy, is the COD tax exempt? Yes. Because XY Corporation declared bankruptcy, and that creates the exception to 68, 61, not 12, 11, because before it was 12. And it results in the COD being tax exempt. Since COD is tax exempt, the tributes will be reduced. Okay, so the bottom piece of this is worth knowing, and this is part of the complication of what you have with respect to COD income that's exempt under 108. That when you have a COD event and it is tax exempt, if you have a COD event and it's taxable, then you just pay tax on it. If you have a COD event and it's tax exempt, then the IRS says you need to give me something in exchange for that. And the thing that the IRS says that you have to give in exchange for that is a reduction of tax attributes. So if a C Corp, for example, has COD income of $1 million and it has a $10 million NOL, I think NOLs are first. The NOL goes from being 10 million down to 9 because that COD is going to reduce the corporate tax attribute of the C Corp. In this case, what I'm saying is that I think you first in an S Corp scenario reduce the tax attributes of the S Corp assets. Then, if there's nothing else, you have to look through the S Corp to reduce the at-risk carryover that exists at the shareholder level. So if we have a balance sheet that had equipment of $1 million, a cum of $1 million, debt of $1 million, and negative equity of $1 million, what are the basis hurdles, Kelsey?
Basis, at-risk basis, passive activity losses, excess business loss.
Okay, does it feel like we would have stumbled over a hurdle here?
Yes.
And how much at-risk basis carryover do you think these people have?
0. No.
How much?
I don't know.
Brett?
Can you say the question again?
Okay. So there's a equipment of $1 million, a cum of $1 million, debt of $1 million, equity of $1 million, and A and B get a K1 with a $500,000 loss each.
Pete, can I back it up and just give a little explanation on, or some context? I think will make this make good sense. So kind of the why this exists. So let's just say you had a corp, and the only thing you did was you went and bought a building, and it was all debt financed for $1 million, and then you wrote the whole building off. That would be a $1 million deduction. You couldn't use it, but it'd be sitting on your return as a basis loss carry forward.
Because of the hurdles.
Next, let's say you can't pay it, so the debt's forgiven, and the building's worthless. So you'd have $1 million of COD income, which would be tax exempt. So you'd end up with $1 million of tax exempt income hit your personal return, which would increase your basis and would free up $1 million of loss that you could take on your tax return. And that the IRS says, hey, you didn't actually lose any money. We're not going to let you take $1 million loss. So if this provision Pete's talking about reducing attributes, if that didn't exist, you could, because of this tax exempt COD income, you could have some, you could use some loss deductions where you didn't economically lose any money.
You also have gitlets. You have gitlets?
For that, but I don't know what that is.
Okay, we'll cover that in a second. Okay, so the at-risk amount, I mean, hurdle one, do you have basis? Does A and B appear to have basis if they're original shareholders and everything was debt financed? Nope. So you stumble over the first hurdle, not even really get to the second hurdle? So they would have at-risk carryover on their return, would they not? So the $1 million of COD income that is experienced at XY would be tax exempt income by virtue of it being in bankruptcy. That tax exempt income would reduce your at-risk carryover that you have at the shareholder level because there are no other corporate attributes. So, do you need to understand that completely? No. Do you need to understand that in exchange for COD income being tax exempt, that you have to know that you have tax attributes that are going to be reduced? Yes, you need to know that. In this Gitlitz case, which I'm surprised I wrote on the page, there was a guy, Gitlitz, that had an S corp, and then the S corp had COD income of $1 million, whatever the number is. So, Alyssa, can you articulate whether basis goes up and down for an S corp? Does basis increase and decrease on an annual basis for an S corp?
Yes.
Why?
But of like income or losses and then distributions.
Income losses and distributions. And 6111 says what?
Cancellation of debt.
Is income, correct? 108 says what?
It's the two exceptions
And
of bankruptcy or insolvency.
yep. So Gitless Corporation met the exception that they were bankrupt. So that made it tax exempt income, correct?
Mm.
So Gitlitz said, I have tax exempt income. If an entity has tax exempt income from bonds, does that increase basis?
Yes.
Yes. So what Gitlitz said was, I had tax exempt income from COD. And going back to John's point of, well, there's this equity and fairness that's in play. So Gitlitz said, I got tax exempt income of $1 million. I didn't get anything out of it. So what kind of loss is that, John?
Ordinary
Capital.
capital.
Capital loss. So he took a capital loss of $1 million on a stock, and the IRS challenged it, and the IRS lost. So he was able to harvest the basis by virtue of having COD income. COD income is tax exempt income. It increases basis. He took capital loss. The IRS lost, and the Congress, in a rare moment of sanity, saw the injustice of that result and legislated around it. Okay, so Brett, the analysis of the exclusion took place at the S corp level, did it not? The S corp's the one that declared bankruptcy. Therefore, we diagnosed the income as being tax exempt, correct?
Yes.
Yes.
Could they have also been considered insolvent in that case?
Yes. Either would work, right? I mean, either now, if you don't go bankruptcy, now you're in the corner of measuring insolvency.
Yeah, in that scenario, because is that assets?
100%. They would be 100% insolvent.
Okay.
Because
Because assets were zero and they're in the debt of $1 million.
we're making the assumption that the widget machine was worth zero. Okay.
So
go back to
that
this.
is
No, we don't know the equipment's value.
that's
here.
fair market value. That's not basis.
Correct. So if the equipment was worth $1, well, we have $1 worth of assets, therefore we're gonna have $1 worth of income. If the equipment was worth $500,000, doesn't matter that it's fully written off. That's a great question. Doesn't matter that it's fully written off. We could go sell it for $500,000 and we have an appraisal that says that we could. Well, assets, debt minus assets, debt is $1 million. Assets fair market value was 500. Our insolvency was 500, so 500,000 is tax exempt and 500 is taxable. That's a really good question. But if the assets were worth 0, when we go throw them in the dumpster, we're fully insolvent. Okay. Noodles, what's this say?
Says consequences to AB LLC due to the $1 million loan forgiveness and bankruptcy. 1. Is the cancellation of debt income tax exempt? I don't know. Wait, what are you talking about?
Because the entity partnership declared bankruptcy, did it not?
Right.
In the S corp, bankruptcy was enough, was it not? So wouldn't we be able to infer, since the partnership was in bankruptcy, that the exceptions met? We should be able to infer that, shouldn't we? But we can't.
Right.
Partnerships are different, and the reason we're talking about this is to highlight that difference. What's 2 say?
2 says, didn't you say that the cancellation of debt income is tax exempt if bankruptcy was declared? Yes, we did.
Okay, what's 3 say?
Why don't you know if the $1 million loan forgiveness is tax exempt cancellation of debt income? Because you measure bankruptcy or insolvency at the partner level and not at the partnership level. A would have to declare bankruptcy or be insolvent. B would have to measure bankruptcy or insolvency.
Okay, this is a bad rule, because partnership has COD. Partnership's going to kick out a K1 that says you have COD income of 500 and 500. Is it taxable? I don't know. Partner A, are you in bankruptcy? Are you insolvent? Partner B, are you in bankruptcy or insolvent? With the S corp, you measured that at the entity level. With a partnership, you measure that at the partner level. And if you don't know that, then you all right back there? You going to sleep?
I'm following you. The camera.
Am I moving too much? Here, let's do this. I'm going to keep. Now I'm screwing with my sister. What the hell was I saying? You measure it at partner level. That is a vicious surprise if you don't know that. So, hey Sam, what time?
I was waiting for you to finish. This was only 6 pages. I didn't think it'd take 45 minutes.
This is important stuff. What are you cackling at her for? Is it time?
It's break time.
It's break time.